Okay, we still have a lot of people eating breakfast, but in the interest of time and to keep on schedule today, we're going to go ahead and start. I'm assuming you can hear me because I can certainly hear myself. I cannot see you, however. This is the strongest spotlight in the world shining right on my eyes. So I'm assuming y'all are there. Thank you, somebody. I'm Sue Douglas. I'm the chair of the Operations Sales and Service Council, and I'm delighted to welcome you back today. I hope you all got your picture made with Marilyn or Frank last night. It was a great reception and a lot of fun, and we thank Scimitar for sponsoring that reception last night, so let's give them a round of applause. How about that food? Chicken pot pie. I've never had chicken pot pie at a reception in my life, and it was good, really good. All right, today I want to remind you that the Ops Council's membership luncheon is today, so if you're a blue string wearer, sponsor, or member of the Ops Council, we hope you'll come to the lunch in Hollywood C on the mezzanine, and the Technology Council will have your lunch next door where you can still talk to the vendors again and network with them during your lunch at 12:30. This afternoon at the networking break at 3 o'clock, the vendor drawings will have occurred, and they will be posted in the Welcome Center on bulletin boards around the Welcome Center. So be sure and come in and see if you want anything, or congratulate those who did if you didn't. Our last networking reception is tonight at 5 o'clock in the Welcome Center. On Approach will be sponsoring that for us, and we'll thank them in the morning. We hope that you will enjoy yourself and thank the sponsors again for what they've done to make this conference great for all of us. I know that many of you know that last night, after much difficult scheduling, we got Sir Paul McCartney to be outside of the parking in the street, and we were able to look over and enjoy him from here. But there was a little bit of concerns with security last night. We're going to try to work it out with the hotel so that those of you who want to watch the back of the top of the head of Justin Timberlake tonight will be able to do that. Cannot make any promises that that will occur, but we're trying to work it out so that it'll be a comfortable place for you to look at the top of the back of his head. So, this morning's session, we are delighted to get an update on what's happening in the credit union industry. We're going to have it from a superstar who will talk to us in just a few minutes, but first, I would like to introduce Wade Whitmus. Wade is from CUNA Mutual Group. He has been a member of the Ops Council since it began 16 years ago. He serves faithfully and loyally on our regulatory committee, so he is very involved in what we're doing. So Wade, if you'd come up, you can have the podium.
Good morning. Thank you for that welcome, and Sue, thank you for the nice introduction. Appreciate seeing you every year at the Ops and Sales Council meeting. CUNA Mutual Group is honored to be a partner with the councils from the very beginning. CUNA Mutual has been involved in helping to support the councils, and we also appreciate this opportunity this morning to help sponsor the general session. For those of you who have been here for a few days, hopefully you've been out on Hollywood Boulevard here, and you probably have seen some of these characters, impersonators out on the sidewalk. I had a chance to observe some of them over the weekend, and it's kind of interesting to see the variety of approaches that these folks have. Many of them, I noticed, just kind of stand there and wait for tourists to come up and get their photo, take the picture, and then they kind of stand and wait for a tip. So that's an interesting approach. And then there's the one gentleman that was out there that I made special note of, and that was the Johnny Depp pirate character. Have you guys seen him out there? Talk about a master, somebody who has passion for what he's doing. He just doesn't stand there and take a photo. I watched him for a while. He'll take a pirate hat and he'll put it on the person's head. He'll align it and get it just right. I saw him with a lady actually working to get the hair out of her face so that the photo would be nice and clear. And then he would work with the photographer and say, well, if you stand right here, you'll get the nice backdrop and you won't have the light and stuff like that. This guy was a master of his craft and he was working with folks. So when you think of the characters you see out on the street and compare them to Johnny Depp's character, who do you think had the most passion? Who was probably the most successful in making the most tips? Probably Johnny Depp, right? Well, CUNA Mutual Group, we've had a passion and a focus on credit unions since our inception in 1935. And we enjoy that opportunity to work with all credit unions throughout the country. And to illustrate that compassion that we have a short video we'd like to share with you this morning.
Credit unions were founded on the principle of people helping people. CUNA Mutual Group was founded to help you achieve that goal. George Feller opened his credit union ledger. The policeman who had been shot while on duty last night just died. He'd taken out a loan for $500 the week before. At least he didn't have a wife and kids, the clerk said. Yeah, Feller said, but he had 2 co-signers. They are legally responsible, and they have families. Nobody forced them to sign. Maybe so, Feller said, but it sure doesn't feel right. It doesn't make sense, Feller said. We insure buildings, cars, houses. Why can't we insure credit union borrowers? On May 20th, 1935, credit union pioneers founded CUNA Mutual Group. Our early business approach? Deliver products that helped credit unions succeed. Credit unions have certainly changed since 1935, growing to nearly 100 million members and $1 trillion in assets. But our approach, along with the spirit and values that guided our early efforts, continue to drive our company today. Our vision is to be leaders. Leaders in lending, helping credit unions make the most of every lending event. Leaders in serving members, protecting more members and delivering increased income to credit unions. Leaders in compliance and risk management, guiding credit unions through the complex and shifting regulatory landscape. Making a difference for credit unions, and making a difference in the lives of millions of credit union members. Together, we follow in our founders' footsteps with a passionate commitment to credit unions and credit union members.
Thank you. Now we know that you have passion in what you do at your credit union as well, whether it's working on the sales or operations side or with technology. You have a passion for what you're doing, and that's why you're here today. But we also know that sometimes our passion takes us deep into what we're doing and we kind of lose track of what's going on around us or what's happening in our environment. And it's critical for us to keep an eye on what's going on in our environment, whether it be compliance changes upon compliance changes coming our way. Rate market starting to change now in the marketplace. Competitive pressures that are coming at our credit unions. And last but not least, certainly, the threat of taxation on our industry. Well, our speaker this morning has a solid background to share with you, being that she has served over 30 years in the credit union industry. She's held various leadership roles, including the president and CEOs of credit unions. She also worked on the prototype for the credit union direct lending program, or as you know it as CUDL. Most recently, she serves as the president and CEO of the California and Nevada Credit Union Leagues. In this role, it puts her in a very unique position to be able to share with us this morning industry and regulatory environment that we're facing and what we see coming up on the horizon that could affect our operations. Please join me this morning in welcoming Diana Dykstra to the podium.
Well, good morning and welcome to California. I want you to know that in every other city, we only dress up on Saturday. Unlike here in Hollywood. It's been a while since I've been in Hollywood. I only live 35 miles from here. But last night I arrived with my daughter and we ran into Paul McCartney. Woo! I saw more than the back of his head, back and the top of his head. But it was a lot of fun, and thank you so much for allowing me to be here today. Lots and lots of things to talk about. I see birds, so all of a sudden, if you hear me change a subject, just go with it. It's okay. I'll come back eventually. It's really interesting. As Wade said, I've been in the credit union movement actually almost 32 years, and the things that we have seen change over the time. Back in 2009, there was an article printed that talked about the 9 things that will disappear in our lifetime. And I read it and went, wow, that's kind of interesting. But I kept those things in my pocket, and I keep looking back at it. So on that list, the first one was the post office. And it's like, really, I love going to the mailbox. And then I keep going to the mailbox today, and all you get is junk mail, right? You never get anything interesting in your mailbox. And now the post office is talking about closing on Saturday. But about 5 years ago, the post office came up with this really wonderful idea, and they sold forever stamps. And my ex-husband bought 1,000 forever stamps. And I said to him, when he bought them, I said, Bruce, why did you buy? Well, they might be a collector's item. I think he'll be living with those stamps forever. The checking account, or checks themselves, will go away. How many of you even carry a checkbook? Oh, come on, there's a couple of you out there. I know you, there's one, thank you. There's an honest person in the room. There's others that you carry it, you just won't admit it. But 55% of consumers don't carry a checkbook, and only 16% do sometimes. My daughter, who is 31, she opened her account at the credit union when she was a little kid, has a checkbook, and she's still on her first box of checks. In fact, she needed to write a check recently, and she lives in Atlanta, and she called me up, Mom, where's my checks? It's like, I don't know, you're in Atlanta, just keep looking. But really, the reality is that the checking account is going to go away. Newspapers. I mean, it used to be that there was a newspaper in every city. There were 3 newspapers in every city, and that is going away. And if we think about credit union's traditional marketing arm, we would put things in a newspaper. Well, what are we going to do without those newspapers? How about the printed book? Ever try to find a bookstore? You know, the printed book has gone away. I'm one of those old people. I like to read a book and put a bookmark in to see how far I've gone and then how much I have left, really. That's the bigger thing. But the printed book has virtually gone away. Landlines. How many of you moved recently and decided to get a landline in your home? Yeah, I was forced to. When I moved, I wanted high-speed internet, and you had to bundle it with a landline. So if people ask me my home phone number, I have no idea what it is, but I have one somewhere in the house. Music has changed. Here you are in the capital of music here in California. Can't buy a 8-track anymore. Can't buy a cassette anymore. I have a cassette. I got a new car. Can't play it. CDs, those are going away. I don't even know, can you buy CDs anymore? Does anybody buy CDs anymore? I guess that's the bigger question. And it's all gone virtual. And the bigger or more interesting thing on that is what happens with new artists and new music. It used to be you'd publish a record, or you'd get a record deal, you'd have a record, the record companies would highlight this new music, and new artists would come about. Well, now I understand that you publish your own music on the internet. I don't know where you find it, but apparently that's where you find new artists. But what's going to happen to the radio, right? Radio depended on record makers and new artists to play music to go forward. And again, radio was part of where credit unions found marketing space. Then how about network TV? Now, I was a little kid. How many were you when you had the UHF channels, right? Right, we had 3 network channels, PBS, and then we got UHF, and you had to turn the thing. It was quite an ordeal to get that. Network TV is going away. It is dying a very slow death, and same thing with cable. I mean, my favorite show on TV is House of Cards, and it's Netflix. It's Netflix. I'm watching Netflix on my TV. So we really, again, another place credit unions play a role. Where are we going to play a role in that? Then how about things we own? All my music is on the cloud. I don't even know where the cloud is. Somebody tell me where the cloud is. Yeah, are all my music in the same cloud, or are they in different clouds? Then my books are in different clouds, and my magazines are in different clouds. Pretty soon, everything we've got is in the cloud. But do we own it anymore? And we talk about big data. Somebody knows how warped I must be given the books I read, the papers I subscribe to, I wouldn't tell you, and the music I listen to. So we don't own anything anymore, and more and more and more it's going away. And how about that privacy? How about that privacy? I'm on my GPS on my iPhone. Everybody knows where I am. My sister's the district attorney in Sacramento, and she's on homicide. She has never lost a case. So if you want to kill somebody, don't do it in Sacramento. But she was talking about GPS on the iPhones and how that really has helped her in her murder cases, because you turn on your phone and you've got the little locator thing, and everybody knows where you are. Well, apparently the NSA knows where we are. They're taping this, and I'm sure that I'll get in trouble somewhere. And then certainly you have Facebook and Twitter. Now, I have a Twitter account. If anybody wants to follow me on Twitter, don't. I now have 302 followers, and I tweeted a lot for a while, and then I went to a conference, and they said, don't forget to use hashtag. And I thought, what the heck is a hashtag? So I was so panicked, I didn't send any tweets because I guess I should have been using a hashtag. Well, I just found out what a hashtag is, and if any of you want to know, I'll fill you in later. But last night when I ran into Paul McCartney, my daughter says, well, use a hashtag. And I go, well, but nobody told me what it is. And she said, you idiot. Everybody has a hashtag. So I hashtagged at credit union. So a bunch of people probably are going, who is this woman and why did she do that? But I bring those things up because the world is changing. The world is changing, and we're going to talk about a lot of things today, but sometimes we get so focused on what was and trying to hold on to what we have that we've got to really look into the future and make our own possibilities. I used to tell a story. Many of you went to Western CUNA, not many of you in this school. I've been teaching at Western CUNA Management School for 16 years, and I've been telling the same stupid story for 16 years. And it has to do with the buggy whip industry. And in 1900-something or rather, the buggy whip conference was having their national convention, and they're sitting in a beautiful room, and there's beautiful windows, and down the street drives a new Ford car. And they all stopped, and they stared at that shiny object going down the street, and they thought, isn't that interesting? Well, that'll never work. We got to get back to building our buggy whips. Anybody know where to buy a buggy whip today? And I think that credit unions are in that inflection point. We're looking out the window going, oh, that technology stuff is kind of interesting. Oh, everybody's going to need a brand. Oh, and we're sitting here not paying attention to the future, and we really need to be looking outward. A little bit about credit unions. Our height in credit unions, in 1969, we had 23,876 credit unions. 1969. Fast forward to today, we have 6,920. A big difference, big consolidation has happened. 49% of all credit unions in the United States have less than 20 million in assets, or 2% of the total assets of all credit unions. However, we have 200 credit unions that have $1 billion or more in assets that represent 51% of the total assets in the system. Banks, on the other hand, we've got just about the same number of banks as we do credit unions, 7,092. Only 2% of the banks, or 134, are less than 20 million, but 668 are over $1 billion and represent 90% of the assets. So we've got to be careful, again, if we're only looking at what we've always done. And I'm traveling around, I get to talk to people, I get to tell everybody what to do, and nobody listens. It's kind of like being a parent. Finally, you're getting some jokes here. Come on. Were you all out too late last night? Probably. I like being the lunch speaker because you're almost asleep, and then I can yell and wake you up. But the morning crowd is always tough. we really do need to pay attention to how we continue to be relevant and how we grow this wonderful, wonderful movement that we all get the pleasure of working in. So a little bit about what's going on in credit union land. I know Sue's going, this isn't what she's supposed to be talking about, but it's all right, I'll get there eventually. Things are improving in credit unions, and if you're in California, Nevada, that's where I spend most of my time. It really feels a lot better. Some of you didn't have the same bumps and bruises. California, Nevada, Florida, Arizona, and Utah really had a tough go at it. Assets are increasing, membership is increasing, and it has done so since bank transfer day. Loan growth, 5.5% loan growth, and you go, oh, that's kind of crappy, but in California, we just hit 2 and we were celebrating. We've been negative since the recession. So we're seeing good loan growth, good deposit growth, delinquency is down, charge-offs are down, ROA is sitting at 0.85. And that one's kind of interesting because 24 basis points of that has been the clawback of our allowance for loan loss. So at some point, now that delinquency and charge-off has gone down, what's that going to do to our return on assets? And those little yields just keep getting narrower and narrower. Housing is improving. There are still some states, Nevada's still 50% underwater. Florida, Michigan, and Georgia are between 25 and 50% underwater. The city of Nevada, 48% of the households are still upside down. So we still have a lot of improvement that needs to take place. Unemployment in the U.S. is 7.6. I wish it was 6.7. 7.6. At the height, it was 10.1. But there's a more important number when we talk about how come we can't get 10% loan growth or the 12% loan growth that we were getting before. It's that consumers don't feel good. And I don't use acronyms, if any of you know me, but if I use one, I owe you all $1. But I don't have enough money, so just bill me. There's an unemployment rate called U6, and it's not an acronym. The Bureau of Labor Statistics have U1, 2, 3, 4, and it goes down. And U6 is the unemployment and then the discouraged and underemployed. And at the height, that unemployment rate was 17.1. It's still 13.7. So people are working part-time jobs, all the construction jobs, all of the high-paid jobs, they're working lower or part-time, lower paid and part-time. In fact, 51% of credit union members it used to be 53% of credit union members worked full-time, and it's now down to 50. So when you think about lending and we think about what we need to do, people are underwater in their homes. And they're not making as much as they used to. In fact, wages in the U.S. are still down from pre-recession. So we have to understand what that is. We also have a lot of threat to our non-interest income, don't we? We've got Durbin that just, the courts just ruled that the Federal Reserve got it wrong, and they've got to go back in and take a look at interchange. Debit interchange is 22% of your total non-interest income. Overdraft, you've got Consumer Financial Protection Bureau really going to look at overdraft and how we charge overdraft. 23% of your non-interest income. Credit debit or credit interchange is 18, and mortgage fees is 17. And I think those of you that are heavy in mortgages in your credit unions really are starting to see a decline because rates are going up. I mean, I would have died in the old days to get a 4.5% mortgage rate, but today it seems awful. Oh my gosh, it's 4.5. I bought my first house and it was 10, and I thought I got a deal. But the non-interest income, so we're talking about changes in the environment. We've got the consumers that are feeling a little bit of drag. We've got all of this regulation. If we didn't have that non-interest income, I'll tell you, in 1991, non-interest income was 6.1% of total income. 6.1%. Today, it's nearly 30%. And without that, our ROA would be negative 61%. So we really have to think about our operations and all the other stuff that's being thrown at us. Credit union member, a little bit about the member. I talked about they're not feeling really good, and I think you know they're not feeling good. We have 33% of the U.S. Households in credit unions. Our average age is 48 and moving up. The average age in the U.S. population is 35.3. So we have an aging field of membership. The interesting thing, and I like stupid facts, and you will too, you're gonna go back and you're gonna repeat all my stupid facts. Do you know what the fastest growing age segment is in the United States? 100 plus. 100 plus. I don't want to live that long. They were just saying my daughter's age, that she was going to live to 150, so the biggest growing segment in our population is 100 plus. In credit unions, the 18 to 34-year-olds are significantly underrepresented in our membership. And what kind of happened, and I looked at lending, the credit unions grew because of the baby boomers. We really were and not all of you are we's. There are a couple of you's out there. But mostly the we's out here really did grow the credit union movement. And if you look at the growth in the credit union, it's as the baby boomers aged. And we bought new cars, and we bought homes, and we got credit cards, and all of that. Well, this great recession did us in. Our house is no longer our ATM. We don't have the jobs. We realize we don't need a new car every other year. We don't need a boat and all of that other stuff. And baby boomers, as you all know, are deleveraging their balance sheets, trying to pay things off. They're not buying those new cars all the time, and they're just done. And if anybody thinks they're coming back the way they were in 2009, we're fooling ourselves. Then we've got Gen Y, who is significantly underrepresented. There are 78 million of them. They're the biggest cohort in U.S. history as far as the number of people. So they're the next baby boomers. And if we're not attracting them, we will just continue to kind of slide down that path. The scary thing is 71% of Gen Y has no idea what a credit union is. And in the old days, see, I talk about the old days. I can talk about the old days. Isn't that cool? Some of you go, the old days, well, last week. When I talk about old days, it really was old. In the old days, we were all employer-based, right? And everybody belonged to the credit union. They all knew that. And we're not that way anymore. So we have got a real big problem in trying to tell consumers who we are. And if we think that that's all right, we got a next generation, Gen Z. I like it. Everybody kind of got tired of naming things. We had the seniors, and we got the boomers, and we got the we all had named the silent generation. Now we're XYZ. I don't get it, but I guess, anyway, Gen Z is now turning 18 years old. And they will be the smallest population, or the cohort that we have ever seen, at 28 million. So there'll be less than 50 billion. 28 million, that would be really little. There'll be less than 50 billion. So if we can't get a hold, and we can't find the way to get in the hearts and minds of Gen Y, we're going to have a really hard time. That 6,900 credit unions, by the way, 27% of them are still losing money today, or nearly 1,900. So if we can't find a way to attract that new consumer, we're in trouble. The biggest opportunity is really interesting. It's the unbanked and underbanked. And underbanked means you don't have a checking account, which I think is funny that we count them as unbanked, because today most people don't even think about the checking account. And we'll talk a little, you're the technology council. You've been talking about payments. Do you really need a checking account? No, you just want an account where you can transact money or transact transactions. That's really profound. That represents 68 million consumers, the unbanked and underbanked, and 52% of them are Gen Y. 52% are Gen Y, and they represented $85 billion in revenue last year. So that is a big opportunity. You just need to figure out who they are and how we're going to get to them. If all of this hasn't depressed you, I now want to talk about regulation and legislation. I really am a very, very positive person. However, there's just been one of those years where I don't have anything good to say, so I try to infuse it with dumb jokes and they go flat. But I try, and I'll continue to try. So how many of you just feel overwhelmed by the regulatory burden? Come on, let's go. You should all jump up and go, yeah, I hate that crap. Excuse me, that's on film. Edit that out there, please. But everybody talks about this fatigue with regulation, the cost, the complexity. The first rule that came out of the Consumer Financial Protection Bureau was mortgage servicing. 1,200 pages. Overwhelming. Anybody have a clue how many regulations credit unions have been subjected to since the end of 2008? 157. So no wonder you feel overwhelmed and fatigued. 157 new regulations. Now the problem is, all of the regulators, whether it's NCUA, Consumer Financial Protection Bureau, FASB, whomever is writing rules, have to send out a notice of proposed rulemaking. And we have an opportunity to make comments. And when we make comments, we can try to make positive change in some of these regulations. We have 6,900 credit unions. Anybody know what the average number of credit unions to write comment letters? 10. 6,900 credit unions, 10 have the opportunity to, or 10 take the opportunity to comment. So if you're a regulator and you regulate 6,900 credit unions and only 10 comment, that means that 6,890 must like it. Now, the trade associations, we write a comment letter on every new proposed regulation. That there's a sea change that happened since the recession, and that is they don't care. They appreciate it. They really do appreciate it, but it doesn't count. Both Richard Cordray and Mike Frizel at NCUA have said, it's great that the trade associations send us this stuff, but we want to hear from the regulated. You have got to be more proactive in knowing what's coming and writing a comment. That doesn't mean you need to read 1,200 pages of the mortgage servicing rule. You don't have to read the whole derivative rule, and we'll talk about that in a minute. But if there's one thing about the rule that you don't like, write a comment letter. Write a comment letter, because this new regulatory environment, 157, we ain't seen nothing yet. CFPB is just now starting. Just now getting started in new regulation. So we've got to be more diligent. NCUA, we've got a lot going on at NCUA. We have a new board member, Rick Metzger. And by the way, if you meet him, he hates being called board member Metzger. He wants to be called Rick. Hey, Rick. He comes from credit union background, so we're pretty excited about that. He was a board member at the then Portland Teachers, which is now On Point Credit Union. Spent a number of years in the House and Senate in Oregon State House. He is very reasonable. I think he's going to be great to work with, and we will see how that moves on. If you get a chance and you're in Washington, D.C., and a lot of you are going, yeah, right, I'm just going to go up to NCUA and meet the board. I tell you what, NCUA, as much as we can complain about them, and we can complain about them, really does want to be an open agency. And if you know you're going to be in Washington, D.C., and you want to meet them, you call them up, and if they're in the office and they have time on their schedule, they will meet with you. They will meet with you. They're people just like the rest of us. Actually, we're smarter than most of them. There, I didn't say that. It's just the media in the room. All this stuff I said that were negative, it's just jokes, right? But we really do have to build a relationship and understand where the regulator is coming from. If you didn't read the derivatives rule, I use that word derivatives rule. Now derivatives, and it's just boring, but it's a great way to hedge interest rate risk. Now, not everybody in this room cares about hedging interest rate risk, because a lot of you don't have complex balance sheets or a lot of fixed rate mortgages, but there are credit unions that would benefit from it, especially in a raising rate environment. So they wrote one that really doesn't mean much and doesn't do a lot of help for credit unions. But the worst part, she had to pay. And even if you thought derivatives were stupid and you objected to derivatives, Every credit union in the United States should have written a comment letter because they are starting something new. Anytime you want something, you got to pay for it. And that is awful. In fact, you have to pay to apply to get derivatives, and then you have to pay to be examined if you took derivatives. So let's just look at that. Anything that we're going to do differently, they're trying to set a precedent as a pay-as-you-go. And that is dangerous, and it is bad. Credit unions already pay into the insurance fund. If you have your 1% NCUSIF deposit in there, and if you're state chartered, you pay overhead transfer. So it is bad, bad, bad governance. We've got a QSO. I see my friend Tim Edwards from Credit Union Direct Lending. We just had an NCUA examination as a QSO. They wanted to come in. They can't come in. We let them come in, and it was, it was a lot of time, and it was a lot of energy, and they have no business. They have no understanding of the business that some of our QSOs are in. Debbie Matz is, Chairman Matz wants to have authority to manage or to examine QSOs. She's not getting that on the comment. We saw that comment rule came out. So she's actually trying to go to Congress and have it embedded into their statute. Risk-based capital. If all of you thought, Basel III, risk-based capital, if y'all thought that wasn't coming your way, well, guess again. I was in NCUA last week, and they are working on risk-based capital. Now, we don't know what that's going to look like, but they use California. They use California for everything that's bad. Now, come on, we got some good things here. We had medical marijuana before the rest of you did. It's true, we did. Anyway, what we're afraid of is we've got this statutory 7% well-capitalized. And they think that there are credit unions that need more capital. So she used two examples of two California credit unions. One that had 9% capital pre-recession and one had 13. They both had the same percent of mortgage loans, and the one with 9% is gone. What she failed to tell us, or failed to recognize, is the one with 9% capital, and those in California, when I say the name, you'll know it's Cal State 9. And Cal State 9 did brokered, no doc, no income verification, HELOCs to 100% to back up purchase money. They didn't know the member. It wasn't their member. They made a ton of them. Of course they went down. But in the other credit union with 13% with the same amount of mortgage, their capital went down to 12.5. So you can't make that comparison. But they believe, especially the larger credit unions, that we need more capital. And where the fear is that the well-capitalized 7 now for the large credit unions, and they're describing large as anybody over 50 million, will now be 11. So we've got, and can you imagine, for those of you that aren't sitting at 11, in this interest rate environment, in this earning environment, how on earth are you going to get to 11, and how quickly? And the only way to do that is to either charge your members more, pay them less, charge more fees, or shrink your assets. None of that is what a credit union is all about. So it'll be interesting to see how that comes out. The next one I'm going to use, and you're going to go, well, what? Credit union-owned life insurance. That's their next thing. So if you have any of that, just be aware. And if you're all going, I don't have a clue what that is, then that's okay. It's not your job. Just go tell the CEO you're in trouble if you've got credit union-owned life insurance. They've got a new guy in town. Actually, he told me I'm the new sheriff in town. And that's okay. We need new sheriffs every now and then. And he does not think that that's a good thing on all credit union balance sheets. So we have a lot of stuff coming out. Examinations this year, it's all risk. Credit risk, interest rate risk, operational risk, any kind of risk you can find out. It's a safety and soundness issue. I will warn you, look out in your credit unions if you have silver bullets and shiny objects. You know those things, it's like, ooh, I found the answer. I know, Cal State 9 found the answer with their HELOCs. In fact, their ROA at top was 2.5. You know, when you make that much money, there's got to be something wrong, because we all can't make that kind of money. But NCUA is really afraid of silver bullets and shiny objects. So if you have a new product or you think you've found the way out of this mess that we've been in for the last 5 years, make sure you have your ducks in a row, because they're going to come after you, questioning you whether or not what you did was safe or sound. I talked a little bit about Consumer Financial Protection Bureau, and I said they are just getting started, and that is true. They are just now done with the legislative requirements of Dodd-Frank. Now the world is their oyster, and we're in the show. With the exception of poor Sue sitting in the room, as long as you're under $10 billion in assets, we were supposed to be exempt from Consumer Financial Protection Bureau. How many of you feel exempt today? Yeah, that's kind of what I was thinking. And I think they mean to exempt us. They say all the right things, but they don't behave that way. And if I want to be not kind and generous, I take a look at Richard Cordray and say, what a behemoth I have to manage. And how do I figure out how to write new regulations for the entire world and carve people out, and isn't that confusing? So he doesn't. They say credit unions and small community organizations or banks didn't cause the problem. They just haven't given us that relief. Now we have the international remittance that is going into place October 28th. Now, I don't know all of your states, but here in California, we have a lot of foreign transactions going out. Silicon Valley, where the hub of technology, we have a lot of foreign workers there that send money home every day. In Southern California, we have a lot of Latino. A lot of money gets sent home every day. And 100 remittances for some credit unions is a month. So 33% of credit unions are getting out of remittance. And the cost is going up for those that are staying in. Some of them are staying in only when they hit 100, then they'll stop. Well, that is a service nightmare. I'm sorry, you're number 101 and we stopped yesterday with 100. So that is a silly, silly rule. They're talking about overdraft. Doesn't like overdraft. Now, CFPB said they're not going, I know, Sue, you hate overdraft, just be quiet. Just shush up, girl. She's my friend, so I can say that to Sue. But CFPB has said, we're not going to tell you how much you can charge. However, we're going to tell you how you charge and maybe how many times. Again, 23% of your non-interest income in credit unions is coming from overdraft. So you've got to be prepared for that. What does your operation look like? What are you going to do? Because we're not going to get exempt from that play. Payday lending, you think, oh, that's an awful thing. We don't do payday lending. Many of you do payday lending. And they think that's bad too. The problem with CFPB is they think that you can regulate good behavior on the part of the consumer. And we all know they won't. My biggest aha on payday lending is when I worked at another credit union in the Central Coast. And we were the big gorilla in a very small market, and the payday lender would come in every week to cash the checks. How many of my employees and really good members used the payday lender was a shock. And they all know. They all had jobs. They understood what they were paying. So you can't regulate good behavior. My fear is they're going to regulate all of the consumers out of the caring, good institutions back into the old days where Larry the leg breaker gives you some money, you don't pay it, and we're going backwards very quickly. Auto lending, they want to regulate some things in the auto lending space. Student lending, more stuff on mortgages. I just refinanced my loan. And I'm a lender. If you didn't know that, I started as a lender. So I know this stuff. Literally, it was a 2-inch stack of paper. What consumer? They want to make things easier. Get back to having a note, a deed, and a disclosure, and get rid of all that other stuff, because as a consumer, you have no idea what you just signed. But it's more. Qualified mortgage is probably my biggest thing that I am railing against. Now, if you're less than $2 billion in assets or make less than 500 loans a month, you're exempt from qualified mortgage. And I know this isn't the lending council, but I'm going to talk about it anyway. It says that if your debt to income ratio, it's one thing. If your debt to income ratio is higher than 43%, it is a non-qualified mortgage. And if you're not exempt, it then opens you up to private action or lawsuits by the consumer that they say, you put me in a mortgage I couldn't afford. Now, those of you that were lenders, and I know I'm not talking to all, how many is a lender out there? Come on, you've got to be a few. Oh, thank you. There are a lot of us. I feel so much better now. So 43% for a single person and 43% for a family of 4 is a very different 43. Credit unions always made great loans. We protected our members. We told our members no when it didn't make sense. We didn't have the foreclosures, although we were collateral damaged to all of this. And all of a sudden, those tools are being taken away. And you go, well, wait a minute, Diana, you just said they exempted us. Now, put your hat on as N2A or your state regulator. You can't sell those loans on the secondary market. They're now risky. And at some point, they're going to come in and say, you know, those non-qualified mortgages that you have, it's too high of a concentration risk. And they'll force us to stop doing what we've always done, and that's make loans to our members. So that's on the regulatory side. Are you depressed yet? You know, you can ask me anything you want. I know everything. Just ask me. Joe's back here from my staff. He knows. I just go in and tell him what it is, and he just shakes his head and says, yes, Diana. But I do. I mean, I get the pleasure of knowing a lot of stuff and gathering a lot of data. So I've probably bored you to tears. I'm really excited about all the things I talk about because this is what I get to live every day, every day. So we've got legislative. Did you talk about Don't Tax My Credit Union when you started here, or you just heard about it in the press? You have not talked about Don't Tax My Credit Union? Oh, my goodness gracious. Technology and operations. You should know about this, right? No, I guess not. All right, so tax reform really has been something that DC has been talking about for a long time. But in the spring, or actually in January of last year, there was a joint committee on taxation was formed. And they worked for months and months and months. And in May, they issued a 568-page report on taxation. There were 11 different committees that produced stuff that went into this report. Of the 11, 2 mentioned that credit union taxation should be eliminated, and 2 said it should be maintained. So we got a 50-50 on this joint committee on taxation. It then went to House Ways and Means, and it went to Senate Finance. Now, people keep telling me, Diana, Washington, D.C. is dysfunctional. This tax thing's never going to happen. It's never going to see the light of day. And you may be right. They can't even vote on the simplest things. However, we know for sure that the House Ways and Means and the Senate Finance have drafted bills on tax reform. And they're approaching it very differently than they have in the past. The House wants to cap income tax rates for businesses and individuals at 25% and keep the bill revenue neutral. Well, what that means is they got to get rid of exemptions. On the Senate side, they said, we're just going to deal with the exemptions and we're going to start with a blank sheet. We don't care what the tax rates are. We want a blank sheet and tell us what exemptions should stay. So right now we're waiting, and in the next couple of weeks we should start seeing those proposals. Now we have, how many of you are around in HR 1151? That was 1998. Not too many of you. Okay, that's my point. In 1998, we made a huge splash. And we had 6 million signatures on petitions because of our field of membership battle. 75% of the congressmen and women that sit in Washington, D.C. weren't there in 1998. And when we go to Washington, D.C., we say, we represent 98 million consumers. And they want to protect their credit union. And the congressmen and women just shake their head, and that's nice, that's good. But the only person that matters to them is their constituent and the people in their district. And we have not raised our political will. So CUNA and the leagues came out in June saying we have got to make a splash. We have got to show Congress, we've got to show the Senate that credit unions in fact do represent people, and our member owners believe in us and will fight for us. CUNA had a big goal of getting 3 million contacts into Congress by the end of July. Today we sit at 1 million. And you go, well, that's a pretty good number, but it's not a very big number. When we talk 98 million and we only have 1 million, that's not so good. And the problem is, you're probably right, we're never going to have a vote on this in this Congress. But once it's on paper forever. And as they continue to the debate year after year after year, if we're not on that paper, we can't get in there. Because there are going to be hundreds and hundreds and hundreds of other groups that want to get back on that paper. So we have to watch this very carefully. Now, that we had a Don't Tax My Credit Union Tuesday on Tuesday, September 10th, and I learned what a hashtag was. That was the first time I used one. I was pretty excited. But we're going to have a virtual rally on October 2nd. So mark your calendar on October 2nd. Pay attention. All you have to do is you're going to tweet out, you're going to do things, I got that right, I didn't say you Twitter out, you tweet out, but pay attention, October 2nd, because maybe that's the day we can really make a big, big noise in Washington, D.C. Now, some other things going on in D.C., not so much. We got Durbin. I talked about that a little bit, and they go, yeah, but that doesn't affect, it only affects everybody, none of us except for Sue. Now, the problem with the court saying the Federal Reserve got it wrong and they want to go back to the table is today we've got 21 cents and about 40 cents is the average credit union debit. There's some pressure, and you see some things changing, and we're going to probably see some downward trend on that. But if the court said 12% or 12 cents probably wasn't right, and it may have should only be a nickel. So can you imagine if credit unions are charging, and the small institutions are charging 40 cents, and everybody else is only getting a nickel, do you think your card's going to be used? It's going to force, market pressures are going to force that to come down, 23% of your net income. So we've got to be watching what's going on with the court. They are on an expedited court schedule. I like they expedited in court, so it'll only be 9 to 12 months instead of 2 to 3 years. But it's expedited. We have to watch that very, very carefully. We also have our bills, member business lending and supplemental capital. And if I asked you, raise your hands, half of you would say we want member business lending, half of you would say not. A third of you would say, maybe a quarter of you say we want supplemental capital, 3/4 of you say not. We have got to stop fighting ourselves. If there's one message I need to say, we need to stop fighting. Those of you that were around in the 70s, we didn't offer checking accounts. It was forbidden. We had no powers to offer checking accounts. So we got legislation introduced so that we could offer checking accounts. The industry, the movement was they were just angry and upset, and how dare us, it's going to ruin us. Can you imagine where we'd be today without the checking account? Now, you may not want member business lending. You may not need or want supplemental capital. But I tell you, every tool in the toolbox is important. Because one day you will. And when you need it the most is when you can't get it. And our job in the trade association and your job is to figure out the tools we need and get them in our toolbox. I don't know where member business lending and supplemental capital go. I doubt we'll get a vote, although co-sponsorship on member business lending continues to grow. We had here in California, Congressman Gary Miller introduced Reg Relief. That's a bill going nowhere. It has no co-sponsors. He really wrote it. He sits on financial services, hoping that maybe there'd be a vehicle to attach it to. We don't see that happening, but it was good that we have it out there, and we will continue to push regulatory relief. The only bill that we think will get passed is the privacy notice. And if those of you that have to send out the notices, you know every year you have to send out a notice. In fact, you get them in your mailbox. I like it, my 401k, right? My 401k. I get like 10 of them every quarter, and you just throw them away, and you think, what a waste, because I'm never going to read this 50-page document. So what the new regulation would do is if you have changed nothing since the prior year, you don't have to send another notice. You only send it when there's a change. It passed the House unanimously. It's been sitting in the Senate, but we have been told that the Senate will take a vote on it in December. So yay, there'd be something that comes out of this do-nothing Congress. Now let's see, I've got about 10 more minutes, I guess. Anybody have any questions? Really, I know everything? Okay, I guess you just know I know everything and you're afraid to ask a silly question, huh? That's it. Some consumer trends, and I'm talking to the choir now because we got a lot of technology people in the room. Mobile is growing 68% annually. Be there or be square, be there or be gone. It's our greatest opportunity, and it is our greatest threat. Credit unions, we've been in it a long time. We take an average of 2 years to make a decision. We do. I mean, we're a cautious group. And we don't want to be the first, and we don't want to get the wrong thing, and is it the right thing? And the board says, well, I don't need it, so you don't need it, and why are we doing that? It can be our greatest opportunity. And I was excited to read, coming out of here, CU Wallet, I knew that Paul Fiore was trying to build up the number of credit unions that were working together on a credit union wallet. That may or may not be the right solution. Doesn't matter. You should be working on every solution. The reality is we don't know what the winner is going to be. And it may be something that has not even been thought of yet. But you got to have something. You've got to be in the game. And it's not about the device. It's about access. And the harder part for credit unions is about seamless access across all of your delivery channels. What you can do in the call center, the branch, online banking, and mobile all has to feel and behave the same. And that's not necessarily the case. And consumers will not stand that disjointed delivery channel in today's world. So we've got to figure it out. It's got to be seamless, and we've got to do something, because doing nothing will only hurt us. We all know P2P is on the verge of widespread availability. I have a payment network of one in California. I signed up for Dwala because I thought it was cool. And my nail place, me and my nail guy, we think we're cool. I get money sent from my account into my Dwala every month or every 2 weeks. I pay him. Every 2 weeks he transfers it back out, but we are cool because it only cost him 9 cents versus 90 cents for my $30 nail appointment. Change, change, change. We talked about, payments are being led outside of financial services. I think that's my biggest worry. We're not leading it. We could be leading this. This could be something big for credit unions because we do it right. We're here about our members. But no, it's not being led by us. You've got the Merchant Consumer Exchange, which scares me to death. That's Walmart, Target, Home Depot. The list goes on and the list keeps growing. That group represents 10% of all household consumption. 10%, and it's growing. And the fact that they signed an agreement with FIS, Fidelity Information Services, to build a payment-to-payment system that is off the rails is worrisome. We've got to pay attention. You have Walmart with Bluebird. How on earth did a prepaid card get FDIC insurance? That's what I want to know. But they did. Then you have Target with the red card. How many of you go to Target? I mean, what a ploy. Save 5% and, get our debit card. Off the rails. And then the credit union gets stuck with all the ACH disputes, right? We're getting nothing for that. Costco's always been in the business. They're just not as slick. But they will be. They will be. And then you have ISIS, which is the telephone, all of the telecoms. trying to figure out how to play. Now, the problem with ISIS is they're playing with MasterCard and Visa. My gut tells me MasterCard and Visa are either they're going to have to reinvent who they are and what they do in order to survive this sea change, because it is a sea change a-coming. I'm excited the Technology Council, your CU Exchange. Is anybody here from Baxter Credit Union? Nobody's here. They're the ones that are being the pioneer. You know, we've got 95 different where? You didn't raise your hand. Oh, you did it like this, huh? Just a little. Oh yeah, I'm from Baxter over here. But we've got 95 different data processing platforms that credit unions use. How ridiculous. No wonder we can't get speedy interface to all of these outside plugins that we need. So Baxter, thank you very much for allowing the credit union system to learn from what you're going to learn, and the Technology Council for having the audacity, as some would say, to try to build something different. So I'm looking forward to seeing where that comes. Consumers are changing. I'm almost done. I think I have 3 minutes. Is that true, Sue? Okay. Well, you guys all talk too long, so you took my time. But that's okay. Today, consumers use their financial institution 82 times annually. In 2010, it'll be 118. And what that says, the more convenience, the more channels, the more use. The interesting thing, however, branch and ATMs have been flat for the last 10 years. And for the first time ever in 2012, branch use actually went down. Now, that doesn't mean you don't need branches, but you need to rethink about what you deliver or how you deliver in your branches. 80% of consumers use a branch once every quarter. And the three main things they use it for, one is to solve a problem. Because when we have a problem with our money, we want to see the person we're dealing with. Two is a complex transaction. And that's usually, they said it's a loan, getting a new loan, or setting up new investments. And the third is they needed me to sign something. So just think about that as we move forward. So in closing, I do have a closing. I don't have a good joke, though. I'll have to figure that one out before I'm done. Is that we really have new business realities. Our income is stressed. Capital preservation is king. So we've got to keep this vigilance that we've had since 2009. And I don't think most of it, I just always laugh when people go, oh, we can get back to the old days. Well, the old days are gone, and these are the new days, and this is it going forward. And 10 years from now, we'll be talking about this old days. So we've got income and capital preservation. We're in a new economy, a very different economy than those of us that have been in this movement for so long understand. And growth is going to be slower, and consumers are still struggling. The regulatory challenge. We've got to figure out how to work ourselves into it and get ourselves out of it. That's a big part of my job. Payment transformation, the shifting demographics I talked about, technology advancements. I just laugh. I'll tell you a story. In Golden One Credit Union, I got the first 1 gig hard drive in a computer. Even the IT people didn't have it. And that 1 gig cost $1,250. And that was in 1996, not so long ago. Now I can get 64 gig on my iPhone, and I'm screaming that it's not enough. Right? I had to take my pictures off and take some of my music off because I couldn't do my other stuff. So technology advancement, again, the 3D printer, have you guys looked at a 3D printer? Those things are amazing. Those are amazing. Well, how's that going to change our world? I want a new toothbrush, I just build one on a 3D printer. I don't know how that works too, but anyway, it sounds good. In my head, it always works good. The non-traditional competitors. We don't know who we're going to compete against. I look out in the world and I see Virgin Money, Prosper, Lending Club, all of those P2P, peer-to-peer lenders. And why aren't we in that space? If you really think about it, If that's such a growing space, we've got members that want more income, we've got members that want small loans at good deals. We are out of play in that. Why aren't we developing that inside our credit unions? We're not getting it anyway, and they go, oh no, we're going to cannibalize our own loans. Well, that sounded like the same argument when investment services came into credit unions. Oh no, we're not going to do that. We're going to cannibalize our own deposits. That's not true. Consumers are going to do it outside of our boundaries. And who better knows the inside is members. Members lending to members should they want to do that. But there are going to be many, many new entrants that we can't even perceive today. And then we really have empowered consumers. I am so smart. It's not that I can answer every question. I could, except I don't want you to ask me because I forgot I left my iPhone down there. But you can find out anything in a minute. And it's easy to leave anywhere in a minute. And it's easy for the consumer to tell what they think about you in a minute, actually in a second. So the consumer is now empowered. In fact, the interesting thing about Gen Y and Gen X or Z is they think it's easy to leave. We think it's hard to leave. They think it's easy to leave. And they will leave a relationship in a heartbeat if you don't do and don't have what it is they need. So I've depressed you all. Really, I didn't mean to. But it really is what we're dealing with today. But I want you to walk out of here saying, we have always had regulation. We have always had problems. And credit unions have always been the ones that look at the possibilities and find new ways into the future. Don't let the weight of this great recession stay on your shoulders. Don't let the weight of all of these new regulations sit on your shoulders and make you think you can't. Because the one thing I know about credit unions is, yes, we can do it. You can figure out ways around it. You can create new products. You can create new pricing. You can do it all because we come from the right place. We come from the heart. We're there to serve our member owners. And don't forget that. Don't let all of this outside noise make you think you can't. Because you can. I know you can. Our mission is clear. We are here to change people's lives. And never, never, never forget that. No matter how bad the news is that I deliver to you, you can and you will go out and find the possibilities, and you will continue to change people's lives. So on that note, I just want to thank you so much. Again, welcome to California. It's been great talking with you. And I hope you have a great rest of the day and a great party tonight and seeing the top of the back of the head of Justin Timberlake. So enjoy. Thank you very much.